Welcome, dear traders. You are watching a recap of the Asian session. The last week of March kicked off with a cautious sentiment. The lull in the markets has been triggered by several reasons. The main one is the risk of a global downturn in the banking sector. Last Friday, in the European session, traders rushed to sell off the shares of the top European banks. Even such reputable banks as UBS and Deutsche Bank incurred losses. It seems that the shock after the collapse of several banks is still present in markets. Investors still remember the 2008 global financial crisis. Even the reassuring rhetoric from the United States and the European Union regulators did not help ease jitters. And last Friday, the US Financial Stability Oversight Council noted that the US banking system remains sound and resilient, despite the stress on some institutions. This council consists of several financial regulators led by Janet Yellen. Earlier on Thursday, Janet Yellen told U.S. lawmakers that she was ready to safeguard uninsured bank deposits in a case of a new bank runs. Given this statement, investors are rather skeptical about the stability of the banking sector. Perhaps that was the reason why Congress asked Yellen to provide more information about the council meeting. Notably, several Fed policymakers said that they did not see any signs of worsening financial conditions. Thus, the regulator could raise rates further. On Sunday, the Minneapolis Fed president made a completely different statement. Neil KASHKARI believes that the recent turmoil in the banking sector and the possibility of a credit crisis have brought the U.S. closer to recession. What predictions did traders make on rates? Earlier, Jerome Powell made rather hawkish comments. However, according to the FEDWATCH tool, more than 70% of speculators factored in a pause in a monetary tightening at the May meeting. The level of distrust remains high despite assurances from regulators. It appears investors took those comments with a pinch of salt. Keep in mind that shares of banks are not just the blue chips. The stability of financial institutions also reflects the state of the economy. Traders are well aware that regulators will not be able to provide financial aid to all banks in the event of a banking crisis. Therefore, the US dollar traded mixed. It started the week moving above the low of the middle of last week. On March 23, the greenback dropped below the psychologically important level of 102. However, since then, it has managed to recover to 103. Today, it's trading without a clear-cut trend due to market uncertainty, which we have just discussed. It needs new drivers, for example, fresh macro stats. There will be some crucial data later this week. In the meantime, the US currency is hovering in a narrow range of 103 and 103.30. The US dollar index touched 103.10 in the Asian session, showing moderate growth. To summon the bullish trend, the greenback needs to break above the resistance level of 103.50. However, it will hardly be able to climb markedly in the near future, especially given the decline in US government bonds. A fall in the Treasuries usually boosts the Japanese currency, and the latter remains weak due to the Bank of Japan's ultra-dovish monetary policy. Yet, its appeal as a safe haven asset is higher as traders know what to expect from the Bank of Japan. Besides, inflation in Japan decreased, and the yen also advanced amid hints from Fed policymakers about a pause in the tightening cycle. It means that the rate gap between the banks could narrow. Last Friday, the yen approached a 7-week high of 129.60. On a Monday morning, the dollar-yen pair quoted at 130.90 due to a rise in the US dollar. However, technical indicators signal a further decline in the pair to the range of 130.40 and 131.40. At the same time, any increase may again trigger a downward movement. The peers are now aiming at 131. Long positions may push the pair to 132. And this afternoon, the economic calendar is empty, so the pair will remain vulnerable to news on the banking sector and the comments from the Fed officials. The AUD-USD pairs are trading with a bearish bias. However, on a Monday, the Aussie tried to recoup its weekly losses, moving in the channel of a 0.6636 and 0.6667. It was able to rise slightly. However, the bullish momentum was rather weak. The bulls only managed to push it above 0.6651. If there is a breakout of the 0.69 level, which is still unlikely, bulls could regain control. The mixed sentiment in the US stock market is exerting pressure on the Aussie. As a reminder, it has a high correlation with the Wall Street. It has already dipped below a 2-week support level of 0.6660. Over the past 4 months, AUD-USD has hit several support levels in the range of 0.6640 and 0.6630. Each of them may become a hard nut to crack for sellers. So it will not be easy for bears to push the pair lower. The New Zealand dollar also added gains. It reached 0.6204 after its recent fall to 0.6187. On early Monday, the Kiwi made an attempt to recoup its early losses. It was trading in the bullish price corridor of 0.6187 and 0.6213. And that's all for now. Hit the subscribe button and stay up to date with the latest market news. Don't miss our next video review, and see you soon.